Understanding the Chicago Fed National Financial Conditions Index, a comprehensive analysis, 1/3. Disclaimer: this article is based on my best knowledge and research. While I strive for accuracy, there is a possibility of mistakes or omissions. I encourage readers to conduct their own research. Introduction. Brief explanation of the Chicago Fed National Financial Conditions Index, NFCI. The Chicago Fed National Financial Conditions Index, NFCI, is a widely recognized indicator that measures the overall financial conditions in the United States. It provides insights into the state of credit markets, interest rates, and market volatility, offering a comprehensive snapshot of the overall health and stability of the financial system. The NFCI is a composite index that takes into account various financial indicators to gauge the tightness or looseness of financial conditions. Importance of monitoring financial conditions in the economy. Monitoring financial conditions is crucial for understanding the broader economic landscape. Financial conditions directly impact businesses, consumers, and investors alike. When financial conditions are favorable, it typically implies that credit is readily available, interest rates are reasonable, and market volatility is under control. On the other hand, tight financial conditions suggest limited credit availability, higher borrowing costs, and potentially heightened market risks. By keeping a close eye on financial conditions, policymakers, economists, and market participants can assess the potential impact on economic growth, investment decisions, and monetary policy formulation. The NFCI serves as a valuable tool in this regard, providing a comprehensive and timely measure of financial conditions that can inform economic analysis and decision-making. Overview of the purpose and significance of this post. The purpose of this post is to provide a detailed analysis of the Chicago Fed National Financial Conditions Index, NFCI. It aims to equip the readers with a comprehensive understanding of the index, its key components, interpretation, and its relevance in policy and decision-making. By delving into the intricacies of the NFCI, readers will gain insights into how it reflects the overall health of the financial system and its implications for the broader economy. What is the Chicago Fed National Financial Conditions Index? Definition and purpose of the NFCI. The Chicago Fed National Financial Conditions Index, NFCI, is a comprehensive measure designed to capture the overall financial conditions in the United States. It serves as an indicator of the ease or tightness of credit, the cost of borrowing, and the level of market volatility. The NFCI is constructed to provide timely information on the state of financial markets and their potential impact on economic activity. The primary purpose of the NFCI is to monitor and assess the health of the financial system. By aggregating multiple financial indicators into a single index, it offers a holistic view of the prevailing financial conditions in the country. Policymakers, economists, and market participants rely on the NFCI to gauge the potential risks and vulnerabilities in the financial system, and to inform decision-making processes related to monetary policy, risk management, and investment strategies. Explanation of how the index is constructed. The Chicago Fed National Financial Conditions Index is constructed using a weighted average of various financial indicators. These indicators are carefully selected to represent different aspects of financial conditions. The weights assigned to each indicator reflect their relative importance in capturing changes in the overall financial environment. The construction process involves three main steps. Selection of indicators. The Chicago Fed considers a wide range of financial indicators, including interest rates, credit spreads, equity market data, and volatility measures. These indicators are chosen based on their ability to capture different dimensions of financial conditions. Standardization and normalization. To ensure comparability and meaningful aggregation, the selected indicators are standardized or transformed into a common scale. This allows for a consistent measurement across different time periods and indicators. Weighting and aggregation. The standardized indicators are then assigned weights based on their relative significance in reflecting financial conditions. These weights are determined through statistical techniques that take into account historical relationships and the importance of each indicator in influencing the overall financial landscape. The weighted indicators are then combined to calculate the NFCI. Historical background and development of the NFCI. The Chicago Fed National Financial Conditions Index was developed by economists at the Federal Reserve Bank of Chicago as a response to the need for a comprehensive measure of financial conditions. The index was first introduced in 1993 and has undergone refinements and enhancements over the years to improve its accuracy and relevance. The historical development of the NFCI has been guided by ongoing research, advancements in data availability, and feedback from policymakers and market participants. Over time, additional indicators have been included to capture changing dynamics in financial markets and to enhance the index's ability to reflect shifts in financial conditions. The NFCI has gained recognition as a valuable tool for assessing the overall state of the financial system. Its long history and continuous refinement have established it as a reliable and trusted indicator, contributing to the understanding of financial conditions and their implications for the broader economy. Glimpse on how to read the chart. To read the Chicago Fed National Financial Conditions Index, NFCI, chart, follow these steps. Understand the scale. The vertical axis of the chart represents the value of the NFCI. It may have a specific range or scale depending on the chart provider. Familiarize yourself with the range and increments used to interpret the values. Identify the time frame. The horizontal axis of the chart represents the time frame or duration of the data. It can range from days, weeks, months, or even years. Determine the time frame covered by the chart to analyze the trend and changes in financial conditions over that period. Interpret the trend. Look at the direction in which the NFCI line or data points are moving. An upward or positive trend indicates tightening financial conditions, which implies higher borrowing costs, reduced credit availability, or increased market volatility. A downward or negative trend suggests easing financial conditions, indicating lower borrowing costs, increased credit availability, or reduced market volatility. Analyze peaks and troughs. Pay attention to significant peaks and troughs on the chart. These points indicate periods of extreme financial stress or ease. Peaks may signify potential risks or vulnerability in the financial system, while troughs may indicate opportunities or a favorable economic environment. Consider the context. Interpret the NFCI chart in the context of other economic indicators and events. Look for correlations or divergences between the NFCI and factors such as GDP growth, interest rates, unemployment rates, or major market events. This broader analysis can provide additional insights into the state of financial conditions. What it means when the index level is above or below zero. If the Chicago Fed National Financial Conditions Index, NFCI, is above the level of zero, it suggests that financial conditions are relatively tighter. This means that borrowing costs may be higher, credit availability may be limited, and market volatility may be elevated. It indicates a potential environment where it could be more challenging for businesses and individuals to access credit or financing. On the other hand, if the NFCI is below the level of zero, it indicates that financial conditions are relatively looser. This suggests that borrowing costs may be lower, credit availability may be more abundant, and market volatility may be reduced. It implies a more favorable environment for businesses and individuals to access credit or financing. It's important to note that the specific thresholds for what is considered tight or loose financial conditions can vary, and the interpretation of the NFCI should be considered alongside other economic indicators and factors. Additionally, the NFCI is often used in conjunction with expert analysis and other economic data to gain a more comprehensive understanding of the financial landscape. We'll continue next Saturday. Thank you for reading my article. If you liked my article and would like to support my work, please treat yourself with something awesome from my Etsy shop. Dreaxia.etsy.com